uh, Next Wave Group. That's the name of the company that we started this last year, and we're talking about this property, Crawford Street.
Next Wave Fund, Fund One. We, started this. Well, it's been about a year or so, and the idea is really to take advantage of what the city of San Diego has implemented. We'll talk a little bit more about it, but the state of California started off with an ADU law where they would allow people to build what a lot of people call granny flats in their backyard. And the city of San Diego said, wow, we can take this, create a loophole whereby we can actually have people build many, many more units than just one single accessory dwelling unit. So we decided to take advantage of that, and now we're doing so. And they are deed restricted units. We'll talk a little bit more about that as well. But the big thing is it's to help attack the housing crisis that we have right now. Of course, all over the state and now all over the country, but specifically in the city of San Diego. So, introducing myself again, Marcelo Valdez. I basically went to the Naval Academy, graduated quite a few years ago now, and I've done. I know one person had joked that I've done the whole tour that you can do in San Diego. Of course, first thing I did was in the military. I was in the Marine Corps stationed at Camp Pendleton. I got out, I went and got a graduate degree, did part of the study in Mexico and the other part here in San Diego. When I got out, I worked at Qualcomm, and so spent about 10 years at Qualcomm. Uh, Ups and downs, of course, with the business. I was laid off at one point and decided to take that to go into the next career, which was in real estate. And so that's why somebody joked and said, well, you've done everything you can do in San Diego, which is, of course, military, Qualcomm, and then now real estate. So with that, we're now on to our next adventure, which is the fund and what we're doing with backyard apartments. Andrew?
Yeah, so I'm Andrew Erickson. So I just a serial entrepreneur. I have an engineering background and worked. I also worked at Qualcomm too. That's what brought me out here to San Diego. So I was a senior engineer out there, and I worked serial entrepreneur. So I started a couple different businesses, and the ones that have really taken off besides real estate stuff are the Amazon companies I've started, private label brands. And so I've built those up and I've sold a few. And I just got really into real estate, and I found this new opportunity here for the building, buying single family homes and building ADUs in the back, and just jumped on it. So, and on top of that, I'm also a leader inside the Titan Network. That's where I know Dan from, who's on the call here, and just really like teaching and helping and learning from other people and stuff. So that's me.
All right. So, as I had mentioned before, of course, the housing crisis that everybody now knows. In fact, it's a little bit funny, not funny, haha, but funny, interesting that I think it's probably the first time I've ever heard when we just had the last presidential election that both candidates highlighted number one or number two, number three, whatever, top three issues they talked about was housing and the affordability crisis. So San Diego, of course, has been victim to this for many, many years. Uh, One of the biggest problems is just, frankly, just underbuilding. Lots of restrictions. They made life very difficult for many, many years, on top of the fact that our own geographic limitations make things challenging. We have the Mexican border to the south, we have mountains and desert to the east, we have the Pacific Ocean to the west, and as I'd mentioned, I'd been stationed at Camp Pendleton, which is to the north. So it almost makes us like an island. We're kind of like a large Hawaii in a way. And then, so you take that, and on top of all of that, you add lots of restrictions and underbuilding. It's really been a really big problem. You can see the graph over to the right talking about construction starts and how low they have been. Now, we actually need to upgrade this because actually the city of San Diego has been very aggressive in doing things like incentivizing backyard apartment building, what we're doing, and other things. So there actually has been there was a big spike up in 2023 in apartment building, so good on the city. But now, because of challenges with interest rates and how things have gotten so expensive, and especially just, construction loans, we're now seeing it drop back off again, although not down to the lows that we're seeing, that these historic lows. So we're doing better, but not good enough.
Yeah, and this is what they have a goal. The city has a goal, 2029. They're trying to build 14 or 13,000 homes here per year, and they're nowhere near that. So there's, yes, there's construction, but hardly. It's kind of the conclusion from this one, from this what we're seeing here. And so that's where the city of San Diego is really pushing for the accessory dwelling units, ADUs. A lot of people think of ADUs as like a granny flat or a like a backyard office. Those are ADUs, and that's kind of the original idea came from that. But really, City of San Diego says if you can have that one ADU, that one backyard unit, you can get as many as you want back there. You can build entire what we call apartment style ADUs. So you can build 4, 8, 12 units. We have a project right now in Ocean Beach that is we're building 12 additional units on a single family lot. And so that's what this special rule is here. And so a decade of decades, many decades of people not wanting to build not in my backyard has now turned into yes in my backyard. Yes, let's build these things in my backyard. So now you're allowed to get. Of course, zoning laws are kind of complicated, but the short of it is you can get one or two of these kind of by right, meaning there's no restriction on it. And then after that, every extra unit you add you have to make half of them affordable and half of them what we call market rate. It means there's no limit on it. And that affordable unit though is still the limit on that's $2,800. So although affordable sounds like Section 8 or sounds like very cheap, it's a San Diego affordable, right? So that's how we're able to take advantage of these special incentives. If you're, and also you don't have to add any parking if you're within half a mile of the public transit. There's a complicated map that shows you exactly what it is, but it's all well defined. And then also there's this concept of a floor area ratio. Again, it's a little bit in the weeds on what that stuff means, but whatever. The short of it is we're allowed to build all these units, which is pretty exciting.
Yeah, and one of the things when we talk about affordable is I liked somebody who's in the industry. The definition is deed restriction, and so we have a certain amount of these units are deed restricted to be capped at the federal government's rate, right? So they say this is what it is. So workforce housing is something you hear in industry a lot, and of course deed restriction, and that's what really makes this really workforce housing, right? So it's not necessarily for it's for I guess you kind of think of it as like people when you think of like nurses, and policemen, students, those kind of folks, right? So yeah, so just talking a little bit more about what we call backyard apartments and how we get there. And we don't, again, like Andrew said, we don't want to get in the weeds, but basically what we've done is we've kind of come up with concepts that we can use over and over again. We can kind of rinse and repeat in order to build and to stack basically two units, but put them together. We can have two or four or six or eight, and it's basically one on top of the other for the most part. And like in this example is what we'll call a six pack, which is one unit on top of another unit. You have a set of stairs that get you up to the second floor, and then we can put them all together in a way that makes it quick to design, quick to permit, and pretty quick to build as well. We have a project. We'll go on to the next. Andrew, if you want to go on, or we can
Well,
talk
I
about.
just want to gush a little bit on your design here,
Oh, okay.
Marcelo. Without getting too technical on this stuff, Marcelo has, is a GC general contractor, and he has these different designs that he's made that are just like truly innovative that I'm pretty excited about. So if you really understand and look at the building codes, there's the special way that you can build these so that it's a stacked duplex. So this is like a 1 unit, 2 unit. And if you build it like this right here is 3 stacked 2 unit builds. And if you do that, it drastically reduces the cost to build, the cost to permit, and the time to permit. And so, although it looks like a full apartment, it's actually a series. It's a series of townhouses basically, and it just makes the design and build process really quick and awesome. So it's pretty neat.
Yeah, and if anybody would ever like to know more, feel free to reach out. It can become a conversation that can go on for quite a long time. So we don't need to belabor it here, but just suffice it to know that we've really worked the code such that we can build much quicker and cost effectively than otherwise. So I had mentioned we showed the graph before about how we underbuilt for so long. This is my first experience with ADUs. This was I can remember 2017. So I purchased this property. We had built a unit in the back, and they were so restrictive that you can look at this as like an ADU, right? You can see the photos below are all photos. Well, no, actually, there's photos of all of the units. But at any rate, we had it. We had the a garage apartment in the back, but the city made me sign a form that was actually recorded. It was deed recorded and deed restricted that I would not ever put a stove in the unit and that I would never rent the unit out, which is crazy. And I had to provide a parking spot because it was only a studio. I couldn't make it a one bedroom because the parking requirements were such that if I'd made it a one bedroom, I wouldn't have had the parking spots to make it fit. So it was only a studio and they had all these restrictions as the bottom line. So
Heaven forbid you actually build a real house for real people. It has to be like, it's crazy to me that used to be the rule.
yeah, just an absolutely ridiculous rule. And so I kind of backed off for quite a long time. Didn't build any ADUs. I was sort of disgusted with the whole process. And then everything changed about 4 years ago, and really about in the last 3 years where people have really been taking advantage. So this is the first one that I did after my experience before with the crazy restrictions. And so this is an ADU, which we're finishing this pretty much finished actually already. And we put three bedroom, two bath units in the back. And you can see, a high quality of build. The interiors look nice, very spacious, 9-foot ceilings. And this is one we're actually keeping. We're going to be renting it out. The other one was a build and we sold it. So good, a lot of good learning from that one. And now we've just, moved on. And from there, we've really taken off.
And then this is the
Oh, yeah.
one that this is a fun one. So this is one that's currently being built, and we have a little 20-second video here. That's good to watch.
Yeah, and this is actually the one that we had showed you with the six pack. That's this design. You can see there's a little bit of split between them, and that's basically fire separation. And so that way we don't have to put in fire sprinklers. And also, when there are only two units, you can permit them as residential as opposed to commercial construction, which is a huge difference.
Hey, quick question.
Yeah.
So are these considered R2 builds then?
No,
R3.
these are
R3?
R3.
So how do you avoid like the fire sprinklers with R3 and all that?
Well,
you
as I
had-
said, you have to separate them. It's kind of like a topic for offline conversation.
Okay,
But you
got
can
it.
do
Thanks.
You can do it, but you got to know what you're doing.
There's a firewall right here. This is a giant, again, without getting too technical, there's a giant big firewall here, and there's a whole process of how you lift it in place and stuff. But you build it as it's literally a building with like a 6-inch air gap, and
Got
then
it.
a giant thick firewall.
Got
Yeah. But there's ways you design it. There's ways you submit to the city. There's like a whole process, like I said, but you can do it. It's doable. And then here's projects that some of these are either Andrew and I have raised, or some of them that I've done previously and with partnerships and that are ongoing or various phases of completion. We've got one, two that are being completed this month and two more that are being completed next month. So getting good experience now in finishing these things out.
And of course, we just kind of put this list out here to kind of show the different stuff. And you guys, of course, can look at them on Google Earth or Google Street View, or also welcome if you're local, drive by. Columbia Street's a really cool one. That's pretty neat. It's a 3-story stacked. So it's 2-story on top of a 1-story. And it's in kind of an Old Town Bankers Hill area, right? What's that neighborhood called? It's like next to the airport, basically.
Yeah, it overlooks the airport, Middletown, but the views are absolutely amazing. They're
Yeah.
incredible.
Neat. But yep, you're welcome to, of course, go out and see any of those if you like, or also we're happy to tour any of these if anyone wants to actually come with us to see all the stuff. And that introduces what now that's all a big build up to say here's what we're actually doing now with this current deal. We're looking at we're in escrow right now at 6509 Crawford Street. Um, and we're doing the same thing. Just like many of these are turning a single family home into 4, 7, 13. We're doing the same thing, turning a single family home into 7 units. And so here's how the process works, and here's our expected timeline. So you can see here's a street view of this house. It's a pretty standard suburban house, nothing super crazy special about it, except for the fact that it has a very large flat backyard. And it's in a really good suburban spot, right? Great spot for where there's a lot of demand for this kind of housing. And you can see here's sort of just a quick render we did of what this house would look like with a 3-stack in the back here. Again, we're still kind of working on some of the designs and stuff, but this is just a very quick conceptual thing since we just opened escrow like a week ago. But that's a concept there. And what we do here, you can see our estimated timeline. We're going to be purchasing. We're in escrow right now, long escrow, so we'll get purchase probably end of January, right, Marcella? Maybe even early
Roughly,
February on this one.
yeah, mid, probably more, a little bit more like mid January. I would shoot for the 15th of January.
We already have the designers already working on drafting up the designs because you don't have to own the property to start designing it, right? So we already have the long escrow is great because we can we don't have to pay the interest payments while we're holding it right now. Then we're going to renovate it, do a short-term rental. So the short-term rental, we did not build this cash flow into the model. It's just like a nice to have. But I figured, you know what? You have this great, beautiful property that's sitting there for 3, 4, 5, 6 months while we're waiting for a permit for construction. Might as well do a short-term rental on it, right? The primary home itself here, that the main home can be short-term rented, like on Airbnb. ADUs cannot be legally rented on Airbnb, but this primary home can. We'll build the property, and we're expecting that to be basically the whole second half of 2025, and then we'll rent it out, and then we'll sell it in Q2 of 2026. And so we're estimating the whole thing is going to take probably 14 months, but we're estimating 18 months just to be a little conservative. And here's more of the details here, a little bit more of the numbers. So we're adding 4 1-bedrooms. We're adding a 3-bedroom unit and 4 1-bedrooms. Purchasing for $750,000, renovate and permit for $250,000. Construction. These are big numbers. I have a whole spreadsheet that itemizes out every single thing down to the nit and gritty, but this is the high level. We think the expected value after everything's done is 2.8 million at a 5.3 cap rate. That's not assuming any appreciation in the market too. We're just assuming a flat market for the next year and a half, which I think is conservative. I think San Diego is an appreciating market, so we could probably expect those things to appreciate, but that's what we're estimating right now. Right now for phase 1, before construction, we're raising 350,000, and then for phase 2, we're going to raise 400,000 to go into construction. And when we're doing this, the way we give a return to investors is we have this concept of a equity waterfall, which I have a cool picture on how it works here in a second. But the way for this equity waterfall, we're giving a 8% annual preferred return, which means that when you invest 100,000, we make sure that you get at least 8%. There's no guarantees. We cannot guarantee anything. There's no promises. These are all anticipated returns, right? But 8% preferred return means that we, assuming we have anticipated profits, that the investor gets an 8% return a year. First profits go to pay that. Second profits are split 70-30 up until 18, and then split the other way. So the investor gets all of the first bite of the pie, and then they get most of the second bite of the pie, and then they get a smaller portion of the remaining bit of the pie, if that makes sense, hopefully. And And then we anticipate over 20%. I have a spreadsheet that shows that it's more than that, but we're just stating to be conservative. We're stating a 20% expected return. And then here's our timeline, which I explained already. And we're expecting this all to be done inside of 18 months.
Yeah, and our experience with that is proving that to be pretty accurate in terms of the timeline, especially considering we're gaining 2 months, right? So we have a 2 month escrow where we're not sleeping on our laurels. And just to have an idea, we started Bancroft, which is the one we showed the 3D, the drone video. We started that in August, and that's what it looked like in October. And pretty much by the end of this month, we'll be, I would say, 95% complete and 100% of the actual structure by January. So feeling pretty good about the timelines as well for construction.
Yeah. And the beauty of this one is it is basically the exact same project as Bancroft. I mean, it's really the same size property, the same size backyard. It's, I mean, within, effectively it's the same size. So it's just the same model, just rinse and repeat, same return, same everything. It doesn't, if anybody who is watching now or is watching the replay, here is the link. If you're interested in this and excited about it, here's the link you can go to, which is investor.avesterinc.com/nextwave. That pops up like a sign-in window. And then when you type in that sign-in, you just create an account, just email password account. And this is what it looks like. So you'll see it pop up. You'll see the logo here as Next Wave. And you have the opportunity section. And then here's the button you want to press, the soft commit. This has no obligation to you at all. This is just I'm interested in this. I'm interested for 50,000, 100,000, 150, whatever it is. So if you're interested, go to that investor/avesterinc.com/nextwave, and we'll make sure to have a link in the recording here too. So there's that. And now
I think the other important thing just to highlight, and I'm sure most people here are in that category, but we are an SEC licensed and registered entity, and as such, we have to declare whether we do investors that are accredited or not accredited. So we're what's called a 506C. So we can only take accredited investors. Just to be clear.
Good point.
Yeah. And the people will question accredited is essentially $1 million of net worth, not including your own personal residence. If you're single, filing single, 200,000. If you're married, filing jointly, 300,000 annual income. Any one of those makes you an accredited investor. And within the system, it helps you to process that so that within 24 hours or whatever, we process it relatively quickly, get a letter that states, okay, this person's accredited and we can move forward.
Yep. Sweet. And you actually don't need any processing to do a soft commit. That's only you can soft commit without being registered. We just can't actually accept your money until you're accredited. So we have the third-party accreditation thing.
Right.
Good point. And also our minimum investment's 50,000, and our maximum. Surprise! You think our maximum would be infinity, but the bank actually requires that we have $150,000 maximum for limited partners. So so up to 150. Cool. And I'm gonna quickly go over the spreadsheet. I know I bore people with spreadsheets, so I don't want to go too much into it, but you can see here, this is our purchase price, $760, $759. We need $280 to close. That includes the renovation, that includes the down payment, renovation, and most of the soft costs too. And then we're raising $350 to make sure we have plenty of room to, not plenty of budget, so we don't have to, we're not fighting for cash later, right? And then here's our estimate for what we expect each room will be when we're done with the renovations. And then add all that stuff up with the 5% vacancy. This is how the bank underwrites it. So this is how we do it, because the bank ultimately person who buys this will be using a bank loan, and this is how they do it. So we follow the way the banks do it, right? So we're expecting a $19,000 rent roll when we're done with this and it's all leased up. Just a standard 30% operating expenses. It's pretty standard. Even the banks will just kind of write that in as a standard thing. Total build cost here is about $1.3 million, which also has a $150,000 renovation, $100,000 soft cost. So this happens before construction, and then this $1 million ADU build happens after the permitting, right? That's the actual construction part of the project. And then there's a lot of numbers in here, but at the end of the day, this is really what I think a lot of people care about. So, what total raise is $750,000, and we're expecting that LPs will be get this according to the spreadsheet. And we don't like overpromising. That's why we say we anticipate a 20% return, but we think that an LP will likely get somewhere between 30%, potentially high, 30-35% annual return to an LP. So again, we anticipate 20%, but this is, if everything goes well, investors will be getting 30-35% return. And I have a whole spreadsheet here. I'll link this out. You guys can see how the equity waterfall works. So you can actually play with the numbers here and kind of see like what does it look like when you change these numbers and put in different amounts and stuff. But at the end of the day, this is what we're expecting. Something like a 30-35% return. There's a couple different assumptions. If the market grows, we've got really nice the next 18 months are nice. Maybe the interest rates come down, maybe whatever comes down, and hey, maybe we have, 5 point, maybe we can exit at a 5 cap, and also the market grows at 10% over 18 months, which is actually average. And we get 6% a year, so 10%, 9% over 12 months. LP returns could be very high, right? But we do not want to promise that, right?
No.
And Marcelo does not like when I show the stuff either. So I'm like, yeah, he
Well,
doesn't like when I do that. He wants me to be super conservative. So,
you roll.
Yeah.
But I will say we are conservatives, and so I'm always pushing Andrew, let's be conservative on this. But even like cap rates and stuff, typically we use a third party to verify our price estimates. Marcus and Milchap, which is a large commercial broker here in San Diego, and they typically come in, and of course it's kind of expected, but they do know the market, and they come in higher than our estimates for final value. And also for cap rates, they're lower as well. So we do really try and be conservative.
Yeah. So that's it. I hope that answers everything, and I'm very open to Q&A now. Or we can finish early and have our Friday afternoon. Yeah, Dan?
No, it's pretty clear to me. And I mean, that the only thing that's a little bit iffy is that, profit sharing. I mean, I didn't understand it 100%, but I kind of understand it. And other from that, it's pretty clear. At least for me.
The short of it is, you put 100,000 in.
Mm-hmm.
So we expect, we're going to raise.
You're expecting a 20% return for the limited partner. That's correct, right?
Correct.
Okay, and that's over a 1.5 year period.
20% annual, so 30. Yeah.
Annually.
So
Okay.
40% over 18 months.
Over 18 months, over a year and a half. Okay. So about 30%. Okay.
Yep.
All right.
And then it all gets returned on exit. So there's no cash flow over the next year because there's no rent because it's all being built, right? But that's the short of it.
And no matter how the market, what happens if, let's say, the market crashes and the value is half? Were you going to keep it or still sell it or exit? What is the deal?
Yeah, good question. If the market does drop, I mean, there always is an option for us to get a loan and keep the property and cash flow it. So we design it such that we have enough equity that we would be able to do that, so we don't have to go do what's called a capital call, which is to go to all the investors and say, give us more money so that we can, keep the property. 50% drops have never happened.
I know, but let's just talk worst case scenario. Trump.
Yeah, I mean, if a 50% drop came,
he will.
all of us have way bigger problems than this particular investment. But I do get your point.
But it happened in 2008. I mean, here in Florida, at least, properties fell more than 50%. So it's not like it's unheard of in history.
Yeah, residential versus commercial. Yeah, residential did. Commercial is a little bit of a different animal, just because of the fact that you continue to get rents and everything is based off of the rents. So, but your point. Your point is valid. Values could drop, and if so, we could refinance and keep the property. But even during the great financial crisis, the big 2008, 9, 10, San Diego rents for a couple of years, they dropped about 2 to 3% for a couple of years and then stabilized. So, and that's very important to know that we're not talking about luxury. We're talking literally workforce housing. So our pricing is priced such that we don't have as high of a ceiling. So if you're talking luxury downtown stuff or whatever, hey, there's a potential that, woohoo, we could do really great, but then you have a greater potential of things dropping. Since this is workforce, we do have a bit of a floor put underneath the rents, such that not as high of a high, but not as low of a low either.
Got it.
Yeah. So, yeah, and on top of that too, there's quite a bit of margin on this. So we'd have to see 15, 20% drop right as we went to market. And so, should expect a 5-10% increase, even 15% increase over the next 18 months. So we should expect that. So if you saw, so potentially, from 15 down to 0 and then yet again negative 15, then we would, at that point, if we saw, I could model this out for you if you want to see the whole thing, but when I played with the model before, a negative 15% drop, which would be the worst, that would be tied for the worst year ever in the last 50 years, right? The same thing as 2017, we saw about that kind of drop, right? 2018. We would, at that point, we would break even and there would be no profit to share, but we would still have return of equity. Now, if it fell 50%, of course, if it fell, like Marcelo said, if it fell dramatically, you would potentially have loss of investment. So there is potentially a 0. However, the way it's structured, LPs cannot have negative. So there is a risk. You could lose the investment. However, you can't ever owe more, right? You're not unlike if you bought a house by yourself, you could put down $50,000 and then you owe more than $50,000 if you try to sell it. You could be underwater. LPs cannot be underwater on an investment. Marcelo and I can. Marcelo and I are personally guaranteeing the loan, so we can be underwater. And I am also putting in 100 on this one, $50,000 of my own capital on this deal. Yeah, so I would also be an LP that lost the 50 and also personally guaranteeing the loan.
Got it.
Yep.
I'm good. Thank you, guys.
Cool.
Thank you.
Anything else, Dan?
No, I'm also good. Thank you, guys.
Cool. Thanks for attending, guys. Appreciate it.
Yeah, really appreciate it. Have a great weekend.
Bye. You too.
Bye, guys.
Have a great day. Bye-bye.
Yeah, well, obviously I'm not going to read it all. It's just, obviously we're not lawyers. We're not CPAs. We are, if you want to get more detailed information regarding legal, accounting, financial, of course, seek out your finance professional. And of course, anything we make here, we have no guarantees. We certainly have goals and objectives that we reach for. And so just know that, of course, any investment that you might decide to invest in comes with potential risks as well as the rewards.